Okay, hello everyone. Welcome to the Microstructure Exchange. I'm Cameron Pfeiffer. I'm at University of Oregon, and today we're here with Taisiya Sikorskaya. Should I do it? Okay.
Yeah.
And she's going to be presenting this paper about ETFs with Evgenii. They're co-authored at London Business School. So it's about 45 minutes for the main talk. The last 15 minutes are going to be open Q&A. Taisiya is happy to be interrupted, so if you have questions, just kind of jump in. I believe Evgenii is going to be in the chat, so if there's stuff that's in the chat and you want to ask it in the chat and you don't want to interrupt, that's fine. If it doesn't get answered in the chat, then I'll try and interject and ask it to Taisiya directly. Okay, and she's happy to stay after if there's a little bit of extra discussion going on. Okay. So I think that's everything from me. So Taisiya, why don't you take it away?
All right, Cameron, thank you very much for the introduction. Once again, my name is Taisiya and I'm from London Business School. Evgenii is also in the audience. We would first like to really thank the organizers for the opportunity to present in this seminar series, and we really look forward to hear your feedback. So this paper is about exchange-traded funds, or ETFs, and in particular, it is about the structure of the primary markets, or the markets where ETF shares are issued. 1 second, sorry. Yeah. Right. So ETFs have grown to over $5 trillion in assets in 2020. So they now represent quite an important investment vehicle for both institutional and retail portfolios. ETF shares are traded on exchanges, and similar to closed-end funds, ETF share price can actually deviate from the value of underlying holdings. And to limit such mispricing, ETFs introduce special markets called primary markets, where the supply of ETF shares gets adjusted. In these markets, only registered brokers can operate, and such brokers are called authorized participants, or simply APs. Understanding what guides the behavior of these brokers is important because they have a right, but not an obligation, to create and redeem ETF shares. And primary markets are also a unique feature of ETFs compared to other investment funds. So these markets have already attracted significant attention from researchers, but due to the lack of appropriate data, the actual structure and granular activity of ETF primary markets have barely been studied, and most academic papers assume the representative AP. Plot on this slide suggests that this assumption might not be that innocuous. We sort US domestic equity ETFs into terciles based on the number of APs who ever created or redeemed shares in 2019. Funds in the first tercile, which is the light blue here, seem to experience larger daily deviations in share price from the net asset value, especially during the COVID turmoil in March. In this project, we aim to understand the differences in primary markets across equity ETFs and explain how and when these differences contribute to mispricing in ETF shares. So to do so, we first collect novel regulatory filings and document several stylized facts about ETF primary markets. We find that funds have a different number of broker connections, varying levels of activity, and that their primary market volumes look actually quite concentrated. We also describe brokers that operate in ETF primary markets. Most of APs are highly regulated entities, and they also provide prime brokerage services. So their reported volumes, in fact, include an activity of their clients as well. The level of mispricing is to a certain extent a measure of how well primary markets function. So in the second part of the paper, we study how primary market features relate to mispricing in the cross-section of ETFs. First, we find that US equity ETFs with larger and more diverse primary markets experience significantly lower mispricing on average. And then we find that this relationship actually comes from days with high financial market stress. And second, the sensitivity of fund flows to mispricing is higher for funds with larger primary markets. In the last part of the paper, we aim to explain these findings. And our leading explanation is that arbitrage between ETFs and their underlying is limited due to IP-specific costs. We theoretically show that equilibrium mispricing is related to average arbitrage costs. And for funds with larger primary markets, mispricing is less sensitive to shocks to such costs. We present several indirect tests consistent with this explanation using several proxies for AP-specific costs, exploiting the Fed's purchases of bond ETFs in 2020, and document that the mispricing of two ETFs commutes more if they share more APs, but only for funds with smaller networks. And finally, we find little support for other channels, such as heterogeneity in fund valuation models or arbitrageur inattention. Right, I will not speak a lot about this actually rapidly growing literature, but let me highlight that to the best of our knowledge, there are only a handful of papers that look into ETF primary markets. And in particular, Pan and Zheng is probably the closest paper in which the authors highlight that the balance sheet management incentives or motives of brokers may affect ETF mispricing and bond markets. I would also like to mention the contemporaneous job market paper of Surovska, who uses the same data as us. She documents also concentration in primary markets and similar cross-sectional relationship with mispricing, yet she interprets these findings as limits to competition. And I will come back to this point a bit later in the talk. All right, if there are no questions at this point, let me start by recapping what ETF mispricing is and why APs play a special role in correcting it. Typically, ETF share price and the net asset value per share move together as shown in this plot. However, a demand shock can move prices away. So in that case, the arbitrageur can sell ETF shares and buy the basket of underlying securities to capture this spread. And this spread or wedge is exactly what we are going to call mispricing in the rest of the paper, which is the absolute difference between the share price and the NAV per share. If the prices converge, then arbitrageur can realize the profits by closing both positions, buying the fund and selling the basket. But there are cases when, or rather, there is always a risk of divergence. And in that case, the non-AP arbitrageur wouldn't incur a loss. And that is why APs are special, because they actually have a right to convert the underlying basket into ETF shares and back at a fixed NAV price. And because of this feature, such a trade is a textbook arbitrage trade for APs or their clients. And it is natural that they're important for keeping their ETF share prices close to NAVs. And even though many papers have studied ETF mispricing, there used to be no data on the actual participants in these markets and their disaggregated activity. And this is exactly the data that we exploit in this project. We collect and send forms from Edgar in which ETFs report all their APs and their respective trading volumes. Since these forms are quite new, we have complete annual snapshots only for 2019 and 2020. We merge AP then entity data from FactSet and also AP prime brokerage clients from ADV forms. And otherwise, our data sources are quite standard. In the first part of the paper, we simply describe ETF primary markets. We observe connections between ETFs and APs plotted in this picture. Here, the blue nodes are APs and the black nodes are ETF families. And you can see that some of these nodes seem to be much more connected than the others. Importantly, we call it a registered connection when ETF and AP have a legal agreement. That is when the broker got registered with an ETF to operate as an AP. And in NSEN forms, we actually observe trading volumes as well. So we see that some of these registered connections are in fact inactive. That is, AP never creates or redeems shares. And the network is even less dense for such active connections. So on this slide, we show 15, top 15 APs.
Taisiya,
yep.
we have a few questions and we have lost our moderator, Cameron, temporarily. Let me post these questions, even though I think your co-author jumped in a little bit here to answer. We had a couple of questions about the mispricing. So Jeff Harris writes, assuming that the mispricing you refer to here is the same as tracking error, that has been the historical term applied to the gap between ETF and NAV prices.
No, not completely. So tracking error is typically the gap between the NAV and benchmark, in fact, or at least to the best of my knowledge, that is the definition. So this is typically, or rather tracking error typically characterizes how well the fund holdings mirror the benchmark that they're supposed to track. But then what we are studying is the other mispricing between the fund holdings and the price in the secondary market, where the ETF shares are traded.
Great.
I hope that explains.
And Anant Madhavan is asking, is it mispricing or price discovery? Their research at BlackRock, I assume, on March 2020 suggested that it is NAV latency. Price moves first and NAV plays catch up.
Yeah, I think it's a valid concern, but mostly so for bond funds. And if I remember correctly, the paper was mostly about bonds and looking at the discrepancies in the investment grade markets. So in our case, we will be looking mostly at equity ETFs where this concern is more muted, but indeed it's hard to differentiate, and we actually do not take a stance on this.
Good. And one more question is posted by Tom Ernst. How exactly do you measure ETF price and NAV? Do you use trade prices, bid prices from quotes or mid quotes?
Yeah, we unfortunately, in this project, we do not have very high frequency data. So we, in fact, use just the close prices from the end of the day. So usual crisp price. But we do have robustness with respect to mid prices for ETF. And NAV, we just take the usual reported NAV, which is also not adjusted for any close price pressure.
Great. Thank you.
Right, thank you. All right, so coming back to this, on this slide, we show the top 15 APs who brought about 98% of the volume in ETF primary markets in 2019. Almost 50% of that volume comes from the top 3 APs. And you can see that APs differ quite a lot in how many funds they're actually active. So overall, this suggests considerable concentration in ETF primary markets. However, for institutional reasons, only self-clearing brokers can become APs in the US. So many of APs in our sample are actually prime brokers, and the reported trading volume also represent the activity of their clients, so the larger number of traders. It is an important feature to keep in mind, because in those cases, APs may not be the end arbitrageurs. And there are only a few brokers in our sample, such as Citadel, whose volumes of trading, whose trading volumes actually come from APs directly. All right, to study the differences in primary markets across ETFs, we construct the following fund level features. The first feature we consider is fund connectedness, which is simply the log number of registered APs. The second feature is primary market activity, which is the number of APs who ever created or redeemed shares during the year. And as you can see, it's only a fraction of registered APs. The third feature is primary market diversity, or 1 minus Herfindahl-Hirschman index of AP trading shares. And finally, as I mentioned, some of the APs volumes actually represent a larger number of traders. So such large APs or APs with larger shares may actually reflect the activity of clients of such APs. So to evaluate the importance of APs who do not bear those additional intermediation costs, we also compute the share of direct primary market volume. It is the volume share of APs who do not provide prime brokerage services. And on the right here, you can see the sample medians. Most domestic equity ETFs have 32 registered APs, but only 7 of them are ever active throughout the year. Trading activity seems quite concentrated, with the median diversity at 69%, and around 18% of the primary market volume actually comes from non-prime broker APs. Having only 2 snapshots does not allow us to study the evolution of ETF AP connections in much detail, but we still see that these connections are quite persistent and their number is slowly growing. And we also look at the cross-sectional correlation and features that I have just defined, and it seems to be relatively high as well. So as a next step, we link ETF primary market features to mispricing in ETF shares. And to do this, we start with the simplest possible cross-sectional regression for all equity ETFs in 2019. In particular, we regress average mispricing on each primary market feature. And to address the potential omitted variable bias, we include as controls a number of fund characteristics that may be related to both primary market structure and the average mispricing. So here we control for fund size, age, liquidity, secondary market turnover, and also include several primary market characteristics such as creation basket size and creation redemption fees. We also include Morningstar category fixed effects in order to make sure that we are not picking up any heterogeneity coming from the nature of the underlying assets. And what we find is that ETFs with larger and more diverse primary markets experience less mispricing on average. And funds with more direct volume also have lower mispricing. Using the specification with all controls in panel B, we can say that one standard deviation improvement in the primary market feature is associated with 15% lower mispricing in fund shares. Indeed, a potential problem with this test is reverse causality. So one thing we do in the paper is that we confirm on our 2 snapshots that past mispricing does not seem to be a significant predictor of future AP registrations or activity. And to further mitigate such concerns, we fix the primary market features as seen in 2019, and then studied daily mispricing in 2020. We assume that market dislocations during the first months of COVID were largely unexpected, and so relating mispricing in 2020 to primary market features in the previous year should partially address this reverse causality issue. We control for the same static fund characteristics, but also include daily controls such as liquidity, turnover, and benchmark return. We also include, again, investment category fixed effects and also date fixed effects. And most importantly, here we introduce interactions with positive and negative FSI dummies that gauge the level of financial market stress.
So Taisiya, yeah. When we have a question here in the chat.
Yeah, sure.
So this is from Anant. So thank you, Taisiya. But if the mispricing was real, that is actionable, we would see flows, but we do not, which suggests either that transaction costs exceed the deviation or that it is net asset value latency. The biggest deviations from NAV are in the thematic funds with a narrow focus, like 3D printing and wind power. And these also have the fewest APs. So I don't know if you have any comments on this.
Mm-hmm. So I think if I understand correctly, there are several things here. First is that even in equity funds, there may be difference in underlying basket that kind of correlate with the number of APs, and hence what we find is due to that. So unfortunately, we do not have a shock to the network per se to be able to identify this better. So the best we can do at this moment is to simply control for those characteristics and introduce fixed effects. And on top of that, we actually have a test on the flows. It's a relatively new test in the paper, where we do find that the more APs a fund has, I will actually show it later, but the more APs the fund has, the higher the sensitivity of fund flows to mispricing. So I hope that answers the question. Anand, please correct me.
Yeah, thank you, Taisiya. That's very helpful. I mean, I think, maybe for the next iteration, you do a joint estimation of the NAV deviation and flows. And, I think really, our research, and this is going back to work I did with Alex Sobchak, who's now at 2 sigma, is that there's sort of 3 values in ETF land. There's the ETF price, which is based on demand and supply and interactions with the market. And the ETF, in the case of the bond ETFs in March of 2020, there were 80,000 trades a day versus 25 trades in the top bonds in those ETFs. So there's quite a bit of illiquidity in the underlying. But my point is that there's really 3 values. There's the price, there's the NAV, and then there's the intrinsic value of the fund, which you don't observe. And you can either try to do that bottoms up by valuing the stocks or bonds and try to make market adjustments, or you can do it top down with a Kalman filter or some state space model. But what drives the flows is the deviation between price and intrinsic value, not price and NAV. And so, I think if you jointly estimate those things, it'd be very interesting addition to this excellent paper.
Okay, thank you very much for the suggestion. We will think how to address it better with the data that we have.
Okay, before we roll on to the next thing, were there any other questions that people wanted to ask to Taisiya? Okay, I'm not seeing any.
Can I ask, because you have a fascinating source of data, but I miss a little bit what the economic mechanisms are that you have in mind when you run these regressions. When Anand mentions these mechanisms of demand and supply in the market, and some people have to take a position and to be compensated for it, et cetera, et cetera. We know that that's going to create price pressures. But then at the same time, at the right-hand side, you push all liquidity variables as a control. So somehow they're outscoped. So what remains for the economic mechanism for a relationship between APs and connectedness and all these things that you talk about? So I miss a little bit the economic mechanism here.
Yeah, I hope that to an extent our model will be able to answer this, because that is where we kind of fix the demand shocks and fix other ETF characteristics. And then the only thing that varies is the participation of APs because of their level of costs. And how we think about it here is that there are shocks to those costs, and some APs kind of are driven out of the market because of that. And that increases the mispricing and creates more arbitrage opportunities for other arbitrageurs.
But wouldn't you, and I'll stop, but wouldn't you expect that's affecting liquidity as well? So when you push liquidity on the right-hand side as a control variable, you sort of consume up there part of the effect.
Yeah, probably we were thinking about it, because I think even the literature already suggests that there is an effect of liquidity on mispricing. And then what we see is that we have actually a test in the appendix where we see that spreads themselves are affected by the network, but here we're trying to control for them and only look at this direct effect of the primary market network on mispricing.
But liquidity and mispricing, the intersection is not empty. Mispricing is sometimes a price pressure, and that's very much liquidity driven. But I'll stop you. There's lots to say about it. I'm a bit worried about the way you set the empirical framework. But I'm a microstructure, so I care about these things deeply. Anyways, go on.
Okay, no, it's very useful to hear, and maybe we should think about how to put them together or think about them jointly here. But it was my impression that it is not so straightforward to do it. But let me maybe show you the model and then see if it gets clear or not.
Okay.
All right.
I don't think I see other questions, so I think you can go ahead.
Okay. Thank you. So estimating this daily regression in 2020, what we find is that in good times, or when FSI is low, after taking into account all controls and interactions, there is little to no relationship between primary market features and mispricing. So as you can see in this first row. However, on days with high financial market stress, having a larger and more diverse primary market network is associated with lower mispricing in fund shares. And these findings are robust to using VIX instead of FSI, alternative definitions of mispricing, and holding subsamples by fund size. And at this moment, actually, some of you might also remember about the potential secondary market arbitrageurs, and that ETF mispricing might look attractive to them too, especially on high FSI days. So what we also report here is the coefficient on primary market transaction fees for both low and high FSI dates. If the observed mispricing is related to some frictions in the secondary market, the primary market transaction fees should be relevant to the resulting level of mispricing because they do not affect arbitrageur costs in any manner. On the other hand, if the primary market is marginal, then the creation and redemption fees should explain the observed level of mispricing in the cross-section. And our results here on the slide suggest that these fees actually get passed through to mispricing only on high stress days, consistent with the idea that primary market features explain observed mispricing. And finally, we studied the sensitivity of ETF daily flows to premium or signed mispricing, as I mentioned in the answer to Anand before. This sensitivity was suggested by the literature as a measure of arbitrage efficacy. The higher the sensitivity, the more responsive the primary market to arbitrage opportunities. We find that quite intuitively, the sensitivity is higher for funds with the larger number of active IPs. In other words, an ETF with larger primary market sees higher inflows after its shares traded at a premium to NAV. All right, let me summarize this part. We documented that the features of ETF primary markets are cross-sectionally related to ETF mispricing, mostly on high stress days. And they also explain sensitivity of ETF flows to premium. We next hypothesized that our results are driven by AP-specific costs, and large primary markets help mitigate dependence on a particular AP and hence reduce sensitivity of mispricing to shocks to APs. I will now present a model in which we try to formalize this relationship, but to get there, let us first look at this break-even condition for arbitrage trades. It is profitable for arbitrageur I to trade through API if expected gains from the arbitrage trade are higher than the primary market fees, ETF specific costs such as short selling costs, and costs specific to this API. We do not observe this AP specific costs, but as I showed earlier, APs in our sample are regulated entities, so they plausibly bear regulatory costs. Some of them might also have cross-business synergies that reduce such costs, or they may have technological trading advantages. So in the model, we actually abstract from the nature of the cost, but assume that they're different across arbitrageurs. So to explain the link between mispricing, primary market composition, and AP-specific costs, we construct a model in the spirit of Gromb and Vayanos 2002. We consider, again, a setup with two segmented markets and assets A and B, and you can think of A as the ETF and B as the underlying benchmark portfolio. The securities are traded at date 1 and then pay uncertain dividends, but identical dividends at date 2. Markets are populated by CARA investors that participate either in market A or market B, and their demand shocks generate this standard wedge in prices. What we introduce are risk-neutral oligopolistic cross-market arbitrageurs who can trade in both markets, yet we assume that they bear costs on the gross position basis. We showed that such a model has a unique equilibrium in pure strategies in which mispricing depends on both competition and the average arbitrage costs. And this is the first prediction of the model. We also consider a particular distribution of costs across arbitrageurs to study the effect of shocks to arbitrageur participation on mispricing. If the leading arbitrageur or arbitrageur with lowest costs is out of the market, mispricing will increase, but it will increase less if the original pool of arbitrageurs is larger. That brings us to the second prediction of the model. A larger primary market reduces mispricing sensitivity to a shock to the lead AP. And next, we take these two predictions to the data. First, we studied the relationship between observed mispricing, number of arbitrageurs, and average costs of arbitrage. The problem is that neither of this, so neither the number nor the costs are actually observable. And as I said earlier, the number of APs is not necessarily the number of end arbitrageurs in this market. And to illustrate this better, we collect regulatory ADV forms and count hedge fund clients of prime brokers in the US who are also APs in our sample. We find that the median equity ETF can be accessed by over 1,000 unique hedge funds with over $1 trillion in gross assets. And this makes the first term in our equation unlikely quantitatively important, at least according to this best measurement that we can do at this point. And we do not also observe the average arbitrage cost. However, we can construct proxies based on observables. We assume that APs with a larger size, higher primary market volume, higher centrality in this ETF AP network, and larger number of prime brokerage clients have lower costs. We average these features across active APs of the fund and find them, all of them are negatively related to mispricing, even conditional on the number of active APs. So consistent with the prediction of the model, observed mispricing is related to proxies for AP-specific costs. And next, we turn to the second prediction of the model and look for evidence of the importance of shocks to APs. To do so, we regress the correlation and daily mispricing between any two ETFs in our sample on the number of active APs that they share, including relevant controls for this pair of funds and fixed effects. What we find is that this beta is strongly positive. So mispricing moves more for ETFs that share more APs. And again, this effect is concentrated in high stress times. Importantly, we see that this correlation is not sensitive to the number of common APs in pairs where both funds have primary markets larger than the median. And this is consistent with our second theoretical prediction that larger primary markets reduce mispricing sensitivity to shocks to APs. And in the last test on model predictions, we exploit that many APs helped the Federal Reserve in its bond ETF purchasing program in 2020. Some of APs in our sample had a larger exposure to the program. That is, they had to trade significantly more to accommodate Fed's demand than usual. If AP's balance sheet is costly and the capital is slow moving, we would expect higher mispricing following shocks to capital commitment. In other words, exposed APs are likely to shift capital internally to the bond desk, raising the cost of equity ETF arbitrage. So we measure exposure of APs by dividing the total Fed purchases of ETFs through this AP by the total trading volume of this AP in 2019, appropriately scaled. And in this test, we'll focus on the exposure of the lead AP, so as in our model, AP with lowest costs. We find that equity ETFs whose most active APs were more exposed to the program experienced higher mispricing during the implementation of the program. And importantly, this effect was 4 times larger and statistically strong only for funds with smaller primary markets. In other words, larger primary markets help mitigate the shocks to the lead AP. And these results do not only provide support for the second model prediction, but also suggest that regulatory costs or balance sheet costs are important in ETF primary markets.
So before we go on from this slide here, Anant has another comment in the chat here.
Sure.
One suggestion is to explicitly model the endogeneity where narrow focus funds have fewer APs than broad-based funds and are more likely to see NAV deviations in stress times.
So that would, if I understand correctly, that would create some link between the N or the pool of arbitrageurs in our model and the value of the shock. Is that the suggestion? Yeah, yeah, we could probably do it.
The suggestion was that yeah, so the basic idea is like, okay, you have some narrow focused, mainly thematic ETFs that are things like wind power, 3D printing, handful of stocks, they don't trade every second or every minute. So there's likely to be NAV latency latency and those are also the ones with maybe one AP or, you know, maybe two active APs. You know, they're just very narrow focused. And so in these regressions where you've got mispricing on the left side and you know, proxies for the network density on the right side, I would just say there's a little bit of, it's almost like a simultaneous equation framework where there's some element of, you know, you've got fewer APs, you know, because the focus is narrow, and because the focus is narrow, there's more likely to be NAV latency. That's kind of the idea. And so maybe there's a way of handling that. That's the suggestion.
Mm-hmm. So I mentioned actually at some point that we have a test on the connections or activity of APs in 2020, where we regress those variables on the previous level of mispricing and different fund characteristics. And in fact, in that test, we actually do not find that the previous mispricing predicts future activity or registrations. In the framework that you are thinking, I guess we should see some relationship like that.
Yeah, I'm thinking more of a game theoretic thing where, you know, you're an AP, you decide whether it's worth making the market in this particular ETF. If it's going to be a hit like one of these ARC ETFs, then great. But if it's going to be just a few trades a day, it's not worth your time, right? So you decide whether to enter or not, and you understand that if there's no competition, there are going to be these mispricing things that are going on. And so my point is that the left-hand side and the right-hand side, there is a relationship. In other words, there's another equation which says how many APs are participating as a function of likely, you know, deviations and the thinness of the market, right? So there's some endogeneity there that you could handle maybe with Heckman style regression or something like that, which would give you some sense of how big that effect is, if it's big at all. Yes.
Mm-hmm. No, thank you for these suggestions. We could definitely add more tests on this. And maybe what I should also mention, it kind of relates to our alternative hypothesis. We were thinking of those funds, as you're saying, thematic funds, as funds in which APs could also have some valuation disagreements, and that could be an alternative story. So let's say they really have different pricing models, and that is what is driving the results. And in that case, what we actually see is that whatever type of the fund we take, our results, in fact, go through. And even if we take different benchmark weighting approaches, where we take simple benchmark weightings or some complex benchmark weightings, such as low volatility weights, we still see the effect of the network, even within that subsample. So I would guess that your concern is there, but probably, so our result just suggests that even within those slices of the funds that are more similar in terms of underlying or benchmark methodology, networks differences still matter for mispricing, but probably we could address it in more detail with a different approach. Are there any more questions?
Yeah, anybody else? Okay, excellent. I don't see any hands or open mics, so go right on ahead.
All right, and I already mentioned one of the alternative hypotheses that we checked, and the other hypothesis we had is that probably arbitrageurs have limits to attention, and probably large networks help mitigate that to a certain extent. So, but we do not find any difference in our results on the days where attention may be limited, so such as the days with more stock level announcements or macroeconomic announcements. So we also rule out this hypothesis. All right, if there are no more questions, I guess I could conclude. In this project, we offer the first description of US ETF primary markets, and we show that ETFs differ in size and diversity of their AP connections. Primary market features are strongly related to ETF mispricing in times of stress. We present a model and some suggestive evidence that show how a larger and more diverse primary market can help mitigate shocks to AP costs. And in other words, two APs are better than one because of the improved risk sharing in ETF primary markets. Our results also suggest the importance of regulatory costs for APs. And finally, they highlight potential contagion in ETF primary markets, as several of our findings imply spillovers through the fund APs. Right, thank you very much for your participation, and I'm really happy to take more questions.
Excellent, thank you, Taisiya. So this is kind of like open question time. So if you've got any like comments about, you know, the generality of the presentation, this is a good time to ask them. So I think Pradeep, you have your microphone open. You can go right ahead if you like.
Thanks, Cameron. What I wanted to first do was to reinforce the point which Anant made earlier on, which is that what you observe as mispricing has to be really inextricably linked to price discovery. And you have different stocks which are being the collection of stocks, and there's differential staleness in prices across those different stocks. And those that differential staleness in prices has to be taken care of in some way. So instead of looking at just contemporaneous correlations and contemporaneous values, I think the controls should think in terms of lead and lag values as well. So going back to the ancient literature of, you know, Dimson and Cohen et al. In relation to, say, betas and incorporating of staleness through looking at lead and lag betas, I think something of that nature needs to sort of come into here, come here into the controls. And sticking to the theme of information, these APs are essentially market makers for the ETFs, and therefore they would trade against the order flow in the process of that market making, and hence I think it's important to look at the informativeness of that order flow at the different periods. So because that will reflect the adverse selection costs which are impounded into the what the AP incorporates or what the APs incorporate into their trading behavior. So these are sort of two general points. I'm not sure how exactly one would incorporate that, but I think informativeness orders should also be controlled in some form.
Okay, thank you very much for these suggestions. I just wanted to make one more thing clear, is that in this project, we're not adding market makers of ETFs. That was my understanding, that they have APs, but they also have designated market makers who have an agreement to, or rather who have an obligation to always make quotes. In our case, we're looking only at APs who have this right, but not an obligation to make the markets. But it would definitely be an interesting angle to add. Thank you.
Irrespective of how you define market makers, APs would trade and manage their inventories and would trade against the other.
Yeah, yeah.
Okay, I believe I see a hand from Peter Lerner. Peter, why don't you go ahead?
Maybe I wasn't here from the beginning. I didn't understand the connection of regressions which you have done with the network model which you presented in the beginning. What is the role of this network model in the whole scheme of things?
Yeah, we don't, let me clarify. Yeah, we originally wanted to take the network approach, but we did not in the end. So I only presented a graph just to visualize how the market looks, that it has a dense core and a sparse periphery. But in fact, everything we do in the empirical design is just project those network features on ETFs.
Let's see. Pradeep, did you have additional comments?
Can I make one more comment since we have the time? One of the things, the arbitrage between the ETF basket and the underlying stocks is very similar to the index arbitrage. The arbitrage which would exist when for arbitraging against index, the traditional index arbitrage literature. So the traditional index arbitrage literature kind of becomes relevant in that context. And I don't want to tout an old paper of mine, but there was I had a paper in the mid-90s which modeled the mispricing in terms of the differential transaction costs of different categories of arbitrageurs, which I think is very relevant in your case. Essentially, what we were doing was to look at the some kind of a threshold model to do the modeling rather than just a linear model. So that's something which you might like to consider. I can send you the old paper if you like.
Thank you. Thank you very much. It would be great. Yeah. Yeah, we were just not completely linking to that literature, probably because of the special feature of APs that they can convert the basket into the fund shares, but probably it could be useful to think in those terms, yeah. Because we thought that in case of index arbitrage, there's always a risk of further divergence, and it's not the case in ETFs.
Okay, I see a hand from Albert. Why don't you go ahead, Albert?
I'm still trying to get my head around everything you find here. And I keep wondering, can you tell me what is this surprising and novel thing that you find here in the mechanism that you sketch, to the extent that I understand it, relative to, let's say, a pre-ETF era, where you have mutual funds, then some of them were marketed by more sell-side firms and some by less, and I understand that there's more firms involved, and maybe mispricings are smaller and flows respond more quickly. Yeah, if you're more central, you might be able to drum up more flow. So all of this stuff sort of is you'd expect, and there's literature on this, as Pradeep mentioned, to see. And now we have the ETF, where we have this this ability of some agents to essentially manage the primary market. But what additional evidence findings do you have that to you were somewhat surprising, given what you were expecting? And relatedly, does any of your findings have regulatory consequences? Is the market just healthy, or is it inefficient in some way? And what would your comments, based on everything you've documented, be for people considering regulation of the market?
Thank you. Actually, when we started working on this project, we did not expect to find this relationship. So maybe ex post, it seems not very surprising, but originally we thought that APs are such sophisticated agents with definitely access to most of the capital in the market. So we were not sure that we should see this cross-sectional relationship between mispricing and the number of APs in the first place. That is one. And regarding the potential for regulatory debate, we were thinking that it's quite interesting that most of the results concentrate in this high stress times. So it seems that in normal times, probably secondary market arbitrageurs are stepping in and keeping the prices of the fund close to fundamentals. But in high stress times, when in general market dislocations are more likely, investors may be, or rather this mispricing may be passed through to the end investor, so ETF. So ETF investors would be trading at those most dislocated prices. And it seems like the more diverse the primary market of the ETF, the less it happens. So that's why, I mean, regulators in general just started collecting this data. And I think our project just shows that there is definitely more potential to look into that direction. But indeed, we cannot make any conclusions yet because data is quite disaggregated. It is annual, and we basically, the only addition in this data is that we see AP identities, and we can decompose the total trading volume into trading shares. Yeah. I hope that answers.
Yeah, and to the extent, but all of that you would expect for the pre-ETF era, where mutual funds and sell-side banks were there, right? So I guess it's just when you have an additional AP, like you have an additional sell-side firm, would make market or create visibility for the fund. There is limits the risk-bearing capacity. So if you have more people involved, not only can you raise more attention, but you'll also be able to spread the risk of any position you might have across multiple. So I see a lot of parallels to what's known in literature. I understand your point. What maybe is new is that you now can identify how many people are involved, which we had trouble in the past. So that's the novel thing. Well, anyways, it's very interesting. Thanks a lot.
Thank you.
Okay. I see a hand from Anand. Would you like to go ahead?
No, really very interesting presentation, great paper. You know, just again on this point about, you made the point earlier about hedge funds, but I think it's worth reiterating for the audience that essentially the APs are very happy to rent out their plumbing, their pipes. And so, you know, there may be a hedge fund that wants to, you know, do a trade. They find there's a gap between actionable, the actionable basket and the ETF price, and they want to do a trade, and they're not set up as an AP. They don't have the legal agreement with us, say, to do that. They're very happy to go to the AP and say, we'd like to do this trade. Can you facilitate it for us? And the AP will charge them a token fee, typically like under $1,000, and they'll never say no to money. So there is this huge fringe of potential competition that is there that can take advantage of real deviations. And I think that's just a point I want to just emphasize, that the market is actually way more competitive than one would think by just looking at the number of APs who are set up because of this potential for renting the pipes.
Thank you. Yeah, that is one of the reasons why we are looking more on the AP cost side and trying to find proxies for AP specific costs of arbitrage. Because it seems like this is to an extent the bottleneck, because APs would still charge those different commissions to their clients. And then that is probably what we're picking up in the observed mispricing.
Okay.
Do I understand correctly that potential contagion in ETF primary markets is just a result of networking between APs, or there is something else going on?
Yeah, how we see it is that there are several funds connected to the same AP, and if those two funds have otherwise small primary markets, then any shock to that AP will basically pass through mispricing in those two funds. Or at least that is how we interpret the test with correlations that I showed.
Okay. Does anyone else have any questions? I don't see any hands or anybody. This would be a good time to ask your questions if you still have some. Okay. I don't see any further questions. I think we can probably wrap up unless people have something. But thank you everybody for joining us at the Microstructure Exchange, and please give like a nice round of applause at home if you're feeling so inclined to Taisiya for giving us a wonderful presentation.
Thank you very much. Thank you, everyone.
Yeah. Have a wonderful day or a wonderful evening or whatever it is everybody's doing. And I think our next one will be in 2 weeks. So yeah. All right. Goodbye, everybody.